Okay, look, we might get the webinar underway. Hello, everyone. My name is Giles Parkinson. I'm the editor of Renew Economy, and thanks very much for joining this webinar co-hosted by Renew Economy and Ashurst, funding net zero green capital for the Asia energy transition. This is the fourth in a series of podcasts on the Energy Transformed podcast series sponsored by Ashurst, which we've been running successfully over the last 8 or 9 months. And the timing of this latest one seems to be quite propitious. We do, of course, have a new federal government in Australia with a completely different approach to climate change and green energy and the green energy transition than the previous one. Just today, the Australian Energy Market Operator has released its integrated system plan, which is probably not a discussion of this webinar, but it is a plan for the future that will attract a lot of investment and pave the way for the further decarbonisation of the grid in Australia and also all the other parts of the economy. And with the support of the federal government, one then presumes that that's going to open up the economy to more investment or more green capital investment. Of course, we're also seeing the energy crisis in Australia and around the world. We've seen an emergency G7 meeting just completed over the last couple of days. Really interesting resolutions about the sort of holding the line on climate, issues or ways to address the energy crisis there and elsewhere, decisions about phasing out internal combustion engine cars by 2035. So fascinating time to be in this space. We've got a great panel lined up for you today. So we're going to have a Q&A session, and then we'll move to, that'll be hosted by Paul Curnow, partner at Ashurst, who has co-hosted the last 3 webinars, and then we'll move into Q&A. Questions from you. So I do invite you to, if you've got any questions, please put them up on the Q&A. You've got 2 options at the bottom there, chat and Q&A. Feel free to chat, but if you do have a question, if you can remember to put them in the Q&A section, then that'll just make it easier for us to have a look and then sort of moderate them and get going. So look, I would like to introduce our speakers today. I'm just trying to call them up here. Okay, so first speaker is Kira Balderstein. She's the Vice President of Renewable Power at Brookfield, one of the world's biggest investors, and has just made some sort of really important announcements about investment in the green energy space. Kira began her career in 2013 in Calgary, Alberta, in Canada. You'll probably notice her accent when she gets online, and she's been working in Sydney since 2015, and she's been responsible for the business development, deal sourcing, due diligence, transaction execution, asset management, and exit preparation of the private equity platform in the Asia Pacific region. Also joining us is Charlie Reid. He's the Managing Director, Asia Pacific of BlackRock Renewable Power. And of course, BlackRock is another one of the very biggest investors, fund managers in the world. Charlie has been with BlackRock since for just over a decade. He's a founding member of BlackRock Renewable Power and led the establishment of the team, firstly in London, and has been working out of Sydney more recently. He is responsible for sourcing, executing and managing climate investments across the Asia Pacific region from the base in Sydney, as well as setting strategy for the business. And finally, Paul Curnow. He is the global co-head of energy and partner at Ashurst. Paul, I've known Paul for this part of a decade now, and he is recognised as one of the leading renewable energy lawyers in Australia and globally, and a market leader in climate change and sustainable finance. Extensive experience in all aspects of the clean energy markets, including in project development, innovative offtake agreements, energy regulation, and financing, and has been involved in this space for 2 decades. And it also includes sort of greenfields opportunities and M&A transactions. Technologies ranging from renewables, pumped hydro, batteries, basically all the things that we need for this green energy transition. So I'm just about to hand over to Paul. One reminder, we do see some feedback and some Q&A. Please do put your questions in the Q&A panel down below. Feel free to chat amongst yourselves. In the meantime, please enjoy the podcast, this webinar, and over to you, Paul.
Thanks, Charles. Thanks for those introductions. And welcome everyone. It's great to be back for the next in our series, and thanks to Kira and Charlie for joining today's session. I just want to start by firstly acknowledging the traditional owners of the land on which I'm joining you today here in Sydney, and pay my respects to the Gadigal people of the Eora Nation and to all elders past, present and future. And it's a great pleasure to be back again. As Giles mentioned, this is the fourth in our series that we've been doing with Renew Economy. And I think what's really exciting for me this time around, we're sort of broadening this out to look at Asia and the challenges, not just in Australia. We've obviously seen in recent weeks huge challenges and dynamic changes in our own energy system. And similar challenges will be across Asia in the coming years. One of the themes for me that's been really important and tracked for many, many years in my career in this space is looking at how do we get institutional investors to be more active, more proactive in the market and the role that they play in really funding the transition to net zero. And I guess that's really, in a nutshell, the topic for today. And we're joined, as I said, by two of the largest investors and proactive investors now in this space through Charlie and Kira, and really pleased to have them as part of today's discussion. Before I sort of open up to the panel discussion, I just wanted to sort of run through a few stats. And I think a lot of you will have heard these before, but I think they're worth repeating just to sort of contextualize the scale of both the challenge and the opportunity when we talk about funding net zero. And really, today's discussion is very much focused on the energy transition, and that's energy in its broadest sense. But of course, when we talk about the climate and the net zero challenge, there are also many other sectors, hard to abate sectors, that we also have to look at. So the challenge, as we know, is of course enormous. Globally, clean energy investment's still been rising at about 12% per year, and this year total invested amount is expected to exceed about $1.4 trillion US. The IEA, in its World Energy Investment Report, says that to get on track for net zero by 2050, we have to invest $2 trillion annually in the power sector alone. And that is an annual rate of more than 25%, or needs a rate of more than 25% per year in emerging and developing countries, including here in the region in Asia. If you look at actually the rate in investment in the power sector in emerging and developing countries, it's only at a growth rate of about 3% in terms of investment. So there's a big gap there, as we know. Across Asia, particularly Southeast Asia, that rounds out to about $190 billion by 2030 required to deliver on the energy investment needed in the Southeast Asian markets. Bloomberg New Energy Outlook has estimated that 44% of the world's renewable energy investment between now and 2050 will likely be spent in APAC, given the size and growth of those countries. That's about 1.6 terawatts of renewables capacity in the APAC region this decade, which is equivalent to about 64,000 onshore wind turbines every year. In terms of meeting that challenge, we've also seen a lot of capital get raised, particularly, as we'll talk about, from institutional investors in recent years. In 2021, the total value of all Asia-Pacific focused closed funds was about $144 billion, up from $135 billion in 2020. And as Charlie and Kira will talk to, we've seen Brookfield and BlackRock and others launch and close a whole range of new funds across the energy transition. And as at June this year, there's approximately $127 billion in dry powder in those investment funds, with an Asia preference focusing on a whole range of renewable and clean energy assets. Now, competition in the region is intensifying. We've also seen the number of active investors in the region rise to 39% in 2021 to more than 3,200, which is compared to an annual growth of about 18% during the past 5 years. So Asia, like many economies in the world, is a big focus for the transition. And I guess finally, one of the things I think we will pick up on, which has been of particular interest to me over many years working in the sector, is the trend of institutional investors, and through the sorts of funds that Kira and Charlie have managed, is sort of increasing exposure to development risk and construction risk. And I think that trend to move upstream is a really significant one that we shouldn't underestimate in terms of the ability for institutional investors to make a real difference in growing the pipeline. Because I think, as we'll talk about, and as we'll hear from Charlie and Kira, this pipeline doesn't just sit there, and it needs to be actively created through the likes of that sort of deployment of early stage capital. So just a couple of sort of thoughts and sort of facts and figures to keep in the back of your minds. So I'm sort of going to open it up now to a discussion, and as Giles mentioned, please do feed questions through the Q&A function. We'll take those questions along the way so we can make this reasonably interactive. So I want to start, Kira, with you, and I guess with both of you, to sort of get a sense around when we've heard about the scale of the funds that you've raised. Obviously, in the context of Brookfield, the Global Transition Fund, I think it's $15 billion closed just earlier this month. And so, that's a huge amount of capital commitments you now have from a range of investors. But it'd be good just to walk us through, what does that Global Transition Fund, what does it really focus on? How does it see the net zero challenge? How does it see its role in really achieving net zero across the energy transition?
Yeah, absolutely. Thanks, Paul, and hello, everyone. So yeah, the launch of the fund, I think, speaks for itself in terms of the opportunities that we see more globally. So I mean, Brookfield has been investing in more operational renewables for decades. We currently have a portfolio of about 65 billion of assets under management and 90 gigawatts of power globally. And with the launch of our latest fund, which you mentioned, we're moving up to focus on kind of the additionality component in the context of the worldwide transition to net zero. So our thematics that we see tons of opportunity, whether it be in the APAC region or globally, as it's a global fund, are across three themes. So one is that, renewables development, we call it clean energy. The second, which is a very unique focus for us, is the business transformation thematic. And while, in this first fund, I suspect that a lot of that capital will be deployed into the energy space, given that that's where a ton of the emissions lie. There's a lot more opportunity existing, for example, in transportation, the electrification of vehicles, and looking at the entire value chain in terms of electrification through transportation. And then similarly, we're also focusing on the circular economy. So we have another thematic that will be possibly a smaller focus of this early fund because a lot of technologies are being developed to support it. But, the likes of waste management, waste energy, and such. So, I mean, our fund is really, looking to achieve typical risk-adjusted returns, as we always do across all of our funds, but also it has a second component where we have to quantifiably demonstrate positive environmental impact. So that's very important to ourselves and our investors to be able to look at a business, look at the business plan and strategy from a transition perspective, and ensure that our capital is being used wisely to facilitate that.
You mentioned at the beginning there additionality, or the addition. Can you just talk to that a bit more? Like, what does that, if you're looking at investments, what does that actually mean as you're screening and looking at those opportunities?
Yeah, absolutely. Good question. Maybe I'll give two examples to try and give some color to it. So additionality is pretty easily represented with renewable development. So you are adding renewable and green power to the grid versus if you buy an existing, solar farm or wind farm, there's no additionality there. You're essentially just, changing ownership. So we want to be, having that positive additionality. That's one example. And then the other is, again, additionality in the context of removing carbon from our atmosphere. So an example of that might be, we recently made an investment into carbon capture storage over in Alberta, actually. So Calgary, where I'm originally from, we made an investment over there. And that's, again, demonstrating that additional positive impact from kind of a carbon perspective.
And I guess in terms of that sort of that risk-adjusted return, is that something in this fund that you can look at a sort of whole of portfolio level, or is it still sort of within some of those segments that you mentioned, or even at sort of the single asset level?
We have our targets at a kind of portfolio level, so at a fund level. But that being said, I mean, when you look at the breadth of opportunities that the fund is targeting, from, more vanilla, let's call it, onshore solar and wind development to possibly, more hands-on and operationally intensive business transformations will obviously be a ban. So it's kind of a risk-weighted return that we're looking to achieve. And I mean, in the context of net zero and our investors, there was no real discount associated with the fund. I think that's a question that often comes up as well, is, are our investors willing to take that discount? And, from our perspective, no, but you don't need to. I think there's a ton of opportunity. There's a ton of momentum, and assets and asset classes that are green or becoming green are being rewarded accordingly. There's obviously almost that green premium that exists for companies that are, going above and beyond right now in terms of the transition.
Yeah, no, that's good. But no, the reason I ask that is because I think, when you look at the breadth of that, even when we talk about clean energy and the things you talked with circular economy, there's such a breadth of assets within that. Of course, the different risk and return profiles are going to be quite different.
Absolutely.
So Charlie, then I guess you're obviously in charge of one of many BlackRock funds focused on climate and energy transition, and I guess your fund is more specifically renewable power, or the latest one that you've raised around that. Yeah, can you talk to how you see that playing that role around net zero, but also I guess in the context of some of the other BlackRock funds that are also focused on other parts of the energy transition?
Absolutely. So when we started the platform back in 2011, it was a renewable power platform focusing on onshore wind and solar. Over time, we've become more of a climate infra platform to adjust with the market. So today we're investing still in onshore wind, solar development, but also in offshore wind, electric vehicle infrastructure, hydrogen, and battery storage. And we're on a global basis, although I would say, and some of the key drivers of this panel, that with a particular focus on Pacific as a key region. Now, as you referred to earlier on, investors historically focused at the asset level, taking on assets when they're operational or construction ready. But increasingly over time, we've moved further back in the chain, really in a private equity manner, to invest in platforms. Because if you're going to invest in development risk, you may as well take a stake in the developers taking that risk. So we're excited with how that's developed, and we're also dovetailing with our Decarbonization Partners Fund, where they're taking more of a venture capital approach to the energy transition.
Charlie, I think we might be getting a bit of feedback on your line there. I don't know if it's the headset or just the bandwidth, but let's see how it goes next time. But just we might have to just test that as we're going. Maybe just then a follow-up question for both of you on those funds, and I guess what you're looking at. I guess part of it is how much do you think your ability to raise the amounts that you have in these funds, how much are you seeing that really coming from, I guess, much more consensus around governments and corporates to net zero commitments? Is that sort of as simple as that you've seen that happen in recent years, and that means you've got a lot more receptivity in those investors to really be investing, or is that almost actually just a reflection of what was already happening and the way you've been engaging investors anyway? Maybe Kira, I'll turn to you first.
Sure. I think it's more the latter. Like, I think there's been, some movement, maybe slower to begin with and more loudly over the last couple of years, I would say, across all of those points that you identified. So, I don't think that our fund was predicated on, specific policies or specific corporates and their commitments, but I think there's been a movement and an increasing focus on this generally. So yeah, that's kind of my short answer to it, is that it definitely, increases our excitement. So I would say that, I think that it was a great time to raise the fund, and I think the conversations are only increasing. And when we look at, partners as well, because we do a lot of partnerships out of our fund, partnering with corporates, not just necessarily, acquiring businesses and owning them. We can partner with corporates that are looking to reduce their scope 2 emissions, and that's given huge momentum. So, leveraging some global relationships that we have to facilitate green energy with big, large, investment grade corporates being willing to write PPAs, again, kind of fuels that. So I think there's been momentum for a while, but yeah, Charles may have some views too, given his kind of longevity in the industry as well, in terms of what's been providing most momentum.
Paul, let me know if the echo issue is still there, and I can try dialing in through advice.
I think it is still there, Charlie. So maybe do you want to just dial back in? And
I will. I'll join you again shortly.
Yeah. All right. No worries. So maybe Kira, while Charlie's coming back online, I guess I wanted to turn now to look at. I think you've given us a really good sense of, the context of these funds and what they're really trying to achieve. Where, I guess, what are the sort of, if we look at the Asia Pac, where are the sort of really interesting, exciting markets for you as a fund investor? And I know you're sort of heavily focused on the Australian market in your own role, but good to get a sense of why Australia particularly of interest now, but also any other markets across Asia.
Yeah, absolutely. So I think, Australia obviously having been flagged, I think another couple that I'll mention are China, Japan, Korea, and Southeast Asia are markets that we view as being strategic and attractive areas to deploy capital. And a few characteristics, I guess, them along with Australia are kind of leading carbon emitters, so kind of the highest carbon emitters in APAC. And we have a philosophy in Brookfield that it's put your capital where the emissions are, because that's, again, where you're going to have the most positive impact. So that's one of the kind of main drivers, I guess, for focusing in on those areas. And then the other is, government mandated net zero targets. So, whilst, China is at 2060, I think Japan and Korea are at 2050, there is still some visibility as to, they're driving towards that, and that again gets the entire sector moving. So those are probably some of the touch points. I guess I did mention earlier too about some of our global C&I relationships, or relationships from the corporate side of things, and they also exist in some of the markets that I identified. So they almost give us a route to market commercially, which helps us in terms of our entry and growth strategies in those areas.
So would you, no, I mean, it obviously makes sense when you think about the largest markets, is where you want to focus with the biggest transition challenge. And although Australia maybe compared to the rest of Asia is not necessarily a huge market in its own right, the decarbonisation challenge of our NEM is of course huge, given where it's currently at.
Yeah.
But is that part of, I guess where there's huge amounts of opportunity for disruption, I guess often can mean you've got better opportunities for higher returns as well. Is that sort of part of what you're looking at as with this fund?
Yeah, I mean, I think it's the disruption point, definitely. And when you can, look at existing markets where you're a meaningful player, and you can look at whether it be specific technologies or commercial constructs that have worked, you can kind of redeploy that in new markets. So, I mean, Brookfield went into China, the Brookfield Renewables Group, that went into China about 4 years ago now. And that's where we commenced kind of in terms of APAC. And today, I think we have more than 4 gigawatts of renewable generation, and that's been built up kind of asset by asset. So we took a greenfield renewable kind of build strategy at the time. So obviously requires a little bit more patience than buying possibly a platform. But there's been tons of momentum and definitely no lack of opportunity. And then, we're essentially replicating that now here in Australia, and in some of those other regions that I mentioned, Korea and Southeast Asia.
Yeah. Charlie, I think you've gone back to the good old iPhone, maybe.
That's right.
Yeah, that's always the good fallback. So it sounds good on the audio. Just coming back to you then, I guess the question I put was really then what are the sort of countries in particular here in Asia? Where are the ones that you are really excited about from your fund, and where do you see sort of the immediate opportunities?
Sure. So maybe looking outside Australia, I'll give you two very exciting markets, Paul. So firstly, for me, Korea is one of the standout markets globally for clean energy. So if you look at the numbers, by 2030, Korea is targeting to have 25% of its power from renewables. It's only at 7% today, which makes it a laggard compared to pretty much every other developed market around the world. Now that creates an extraordinary growth opportunity with a requirement for 65 gigawatts of renewables by 2030. So essentially building the size of the NEM in renewables in Korea. If you then look out further to 2050, and Korea, like other markets, has a 2050 net zero target, they need to build 500 gigawatts of renewables. That's a $1 trillion investment opportunity in the energy transition in Korea. So we see that as a key market. Another market is Taiwan, which for me is an archetypal energy transition market in Asia. There they have a target of net zero again by 2050. The majority of the capacity, although people talk about offshore wind, is going to come from solar, with potentially 80 gigawatts of solar being installed between now and 2050 in Taiwan alone, all backed by a 20-year feed-in tariff by Taipower. And I would say that if you look at Asia Pacific as a region and you look at a $100 trillion funding requirement to get to net zero globally, Asia Pacific will represent more than 50% of the challenge. And we see the race to net zero being won or lost in this region.
Yeah, no, some sobering numbers, staggering numbers there. And when you add the time frame required, I think is even, just your mind boggles a bit actually, which only to the point why we need all of the money that you guys have from your investors to actually make it happen. So I guess I want to turn now to talk about, I guess what makes those markets compelling. Apart from the overall size, I think that's an obvious reason why you would focus on some over another in terms of how you deploy your capital. You mentioned 20-year feed-in tariff from Taipower, Charlie, and of course policy, those sorts of longer term policies with good certainty, I guess less sovereign risk and those sorts of issues, of course, drive a lot of investment. So I guess I'm trying to get a sense of how risk averse or otherwise is your appetite. You're not going to get that in every market, as we know. We don't even have it in Australia or anything near that. So give us a sense of how you look at those policies and what that means in terms of how you look at risk and the opportunities in those markets.
Sure. So scale of market is just one factor. Our scale of market does define sort of velocity of capital, risk-adjusted returns, but the key is the underlying risk return of the assets. And a key determinant in renewables is the power purchase agreement or lack thereof. So in a market like Korea, where for renewables projects, you enter into a 20-year power purchase agreement with a KEPCO subsidiary, that is a fantastic contract to have, and really underpins the investment decision for us as equity investors, but also when we're out in the market raising debt. So I'd say the one thing that in fact, two things governments can do to really help us get to net zero is, first of all, providing those kind of long-term revenue contracts to attract institutional capital. And then secondly, what we're finding in markets across Asia, Korea, Taiwan, also here to some extent, is that despite grand national net zero and renewable energy targets, projects at a local level aren't keeping up in terms of pace of development. So I think those are two key factors that we look at when we're assessing markets.
Yeah, no, it's a good point. I think because national ambitions, even if they're legislated, can be great, but you still need tangible mechanisms that drive a lot of that. Those points you mentioned. But Kira, then how do you see that in the Global Transition Fund? How certain do you need around sort of fully contracted offtake or appetite for merchant exposed risk, those sorts of questions?
I think, I'd probably, confirm a lot of Charlie's perspectives in terms of the necessity of, a strong off-taker to kind of underpin your underwrite at the development stage of things. And it kind of flows through to project finance. And I think that was a point that I might reiterate around a couple of the markets that we're focusing in the broader APAC region, is leveraging the global relationships that we have with major corporates who are willing to write those PPAs, and they have presence, in these other APAC markets. They can be a leading entry point for us, whereby we, have worked with them before. We know how to work with them now, and it can kind of get, projects up and running quite quickly. So that absolutely is kind of a critical element. And then when you look at it, I mean, we're looking at, again, kind of proven renewable technologies. So, we're just doing onshore wind and solar for the most part in many of these regions, whereby other areas of the transition fund, are newer technologies, and there's, a level of risk that comes from that. So assuming that you do have a strong corporate or other entity, willing to take an offtake, that's a very strong starting point.
Yeah, no, well, that's obviously a key thing around that, managing that risk. I think, Giles, I see there's a few questions coming. Did you want to jump in and take some of those at this point?
Yeah, happy to, Paul. Thank you very much. This is about, well, there's a couple of questions here about Sun Cable. You talked about the, Charlie, you talked about the scale of the projects happening in South Korea. A lot of them seem to be government mandated and things like that. And I don't know whether you want to sort of dive into a particular project, but Sun Cable, of course, is the, well, it would be the biggest battery and solar project in the world. And it's sort of looking to power industry in Australia and also export that power through this massive subsea cable to Singapore. Is that the sort of thing, Charlie, and that you'd be interested in?
Yeah, so what I would say is that projects like this are a very noble endeavor and can be a key ingredient when it comes to net zero. I think the challenge from our side is that the length of the development timeframe and the scale that you need to believe in order to bank those projects. It's the same in hydrogen, where we see very large scale projects being developed, for example, in Western Australia, which require the development of a global hydrogen market to really achieve full scale. So I would say that through our funds, we tend to focus on projects which have a slightly shorter fuse in terms of development timeframes, which might not have necessarily the same impact. That said, I think these are great initiatives. They should be supported. And I think in the long term, we'll look back and see them as playing a key role in energy transition.
But you might, for instance, you might not be asked to actually come on board until they actually get to the stage where they're getting close to financial close. And to do that, you would assume then they've got agreement from a government buyer at the other end of the scale, kind of what you would have in South Korea. Presumably at that time, they might be a year away from construction. Is that when you'd be be more interested in engaging? Exactly,
that's exactly right.
Yeah.
So I think that's it's a key point for the institutional capital that we represent, is line of sight to that offtake agreement.
Okay. Kira, do you have any perspectives on such projects?
Ours is similar in terms of at what point could we come into a project of such size and probably duration of the development side, because we do manage close-ended funds. So they're kind of 10 to 12-year funds, and that dictates somewhat the size of the projects that we can take on. So offshore wind is another one that, at least in Australia, is probably a little bit too early stage from a Brookfield Global Transition Fund perspective, just given where we're at, albeit there are other geographies that are much further progressed where we would be participating in a much more meaningful way. But that being said, we'll watch these projects very closely. I think, the impact that they can have is massive. And if there is a role to play at a later stage, our capital would be ready and able to do so.
Yeah. Charles, you mentioned hydrogen, and there's a couple of questions about hydrogen markets there. Of course, green hydrogen comes in very many colors. So I'm just wondering whether you have a specific mandate, and I'll throw this question to you too, Kira, because you're talking about sort of transitioning companies. So do you jump into a company or a project that's got blue hydrogen and try to make that green? I'm not even too sure if that's possible, or do you just start off with green hydrogen at the start? Or what do you think overall of just the hydrogen possibility?
Yeah, so we just focus on green hydrogen as part of our mandate, and that means that it's hard to find projects at the moment, but we expect a significant ramp up of projects over time. So we are looking for more concrete projects with offtakes at a small scale to start with, compared to some of the very large development projects that we've mentioned. And I think a lot of these projects we're going to find in North Asia, in Korea and Japan, where there is a government mandate to roll out hydrogen at scale. Now, in those markets, they're looking to import 80% of their hydrogen over time, but I wouldn't be surprised if actually they end up importing less and the government supports more local supply of green hydrogen. To give you one example, we own a fuel cell project in our Curnow platform in Korea, and we're currently out of the market trying to source green hydrogen for that. So that's an example of a more concrete project that we're looking to get off the ground.
Kira, do you have any perspective on that, green or blue?
Well, I think we theoretically can do both, but you're right, Giles, where we would be looking to transition green or blue to green, change the traffic lights there. So that's no problem. It's the same as looking at thermal intensive assets and transitioning them to green. In terms of hydrogen at present, I think we see a lot of potential. Obviously, Australia is kind of pegged to be a massive exporter of hydrogen. If you're reading any of the reports, I mean, when that comes to fruition, I think is a question mark, but a ton of potential there. Yes, different markets, you can almost map the importers and the exporters and take a perspective as to where you would look to invest. I guess the one place that we have put some capital to work is over in North America. We've partnered with Plug Power, and they are kind of a hydrogen producer, but our element is we provide the green power. So we're kind of sticking to what we do best, and we partnered and we're kind of participating in the value chain there, but sticking to the renewable power generation at the moment. But I think that this will become much more meaningful component of funds and the conversation, a couple more vintages from today. So if Charlie and I are on a webinar in 5 to 10 years from now, we might be talking about all the hydrogen deals that we've done. That's kind of my view. But I think for now, it's pretty early days.
Cool. Back to you, Paul.
Yeah, well, I was just going to pick up a point there. I think some of the, if you look at obviously we look at gas prices at the moment, you'd have to say blue hydrogen using gas just to produce hydrogen on those prices doesn't really make sense if there's an other use for it. But I guess so. And I think probably the other thing in 5 years' time, Kira, we're probably not talking about green and blue. I think it'll just be through a global guarantee of origin scheme, if that something like that, probably more just around emissions intensity in hydrogen, and I guess have countries that use that in a way that sort of fits in with their net zero. But yeah, I think on hydrogen, I guess the gestation periods are still many years away to large scale projects, just as Charlie mentions. Just want to come back then to, you mentioned, Kira, that in China you had sort of gone down the route of sort of greenfields projects doing your own development. And Charlie, I think in the introduction, Giles mentioned that with your fund, it's also been looking at sort of portfolios and platforms. And I guess there's many ways to grow the pipeline for what the asset classes you need to which to deploy the capital. I guess just want to sort of get a sense of how do you see, to me, the big challenge, and you mentioned this, Charlie, a discrepancy between national goals and then what's happening locally in terms of the ability of those signals to really come through and make those projects build that pipeline. So maybe Charlie, just coming back to you to start, how do you see that pipeline really growing? And I think you talked about perhaps a slightly more private equity model, for example, as a way to sort of facilitate that. But if you can just sort of talk through the role of how your fund is really helping grow that pipeline, rather than just sitting there waiting for assets to come through for asking for capital.
Yes, so we've moved from waiting for the market to making the market. So in each of the markets where we're operating in Asia Pacific, we have backed one or more teams to develop infrastructure across pure renewables, but also battery storage and EV charging, which I think we should spend some time on as well as part of this panel. And we're finding that's a better way in terms of putting development capital to work, having more of an impact, both in terms of finance, but also climate impact for our investors, but also then having more control over the quality of the developments and how we finance those projects and contract them. We feel that that is a more efficient model for us and our investors moving forward, and one that really helps take us towards net zero, rather than being the recipient of beautifully developed projects after they've been through a lengthy development cycle.
Yeah, well, I think, and Kira, I guess, how are you looking at that? Because obviously you've done in China sort of very greenfields. Is that still part of the mix as much as sort of the portfolio play?
Yeah, absolutely. I mean, we do look at both. But I agree, there's a lot of capital in the market, and there's a lot of competition for renewable platforms in Australia, as an example, that have that mix of operating and brownfield assets and greenfield assets. So I think to the extent that you have the patience and drive to be doing a little bit more work earlier on, we also we kind of create partnerships with many developers kind of in regions, and then we can work with them to really expedite their platforms all at once. So we bring, yes, a tremendous capital, but also some operational capabilities where we can kind of step in earlier. So yeah, we pursue both, but I think there's just even more capital at the moment for those lower risk platforms with operating assets or development assets that are further along the spectrum.
Yeah, I mean, I think if you just take Australia as an example, I mean, 10 years ago, projects were just coming through at financial close or even at COD, and that's where we saw a lot of the investment happening, right? But of course now there's hardly any projects coming through, at least single projects, and it's all about those developed platforms. And I think, Charlie, it sounds to me like what you're describing and building is really a similar approach across the rest of Asia, if in terms of getting in and being part of that opportunity.
That's right.
Just then, if we come back to your funds, and I guess one of the things I'm interested in is also, where are if you look at your investors into these funds, where are they, subject to how much you can sort of say, but I guess generally, where are they sort of coming from? Are they mostly out of Europe, North America? And I guess one of the things in the Australian context, how much are we seeing Australian super funds really being part of the investment into the Asian markets at the moment? Maybe Kira, if you could sort of talk to that first.
Yeah, sure. So I think in the context of the latest transition fund, I think our investor base was pretty consistent with those in our other global funds, and we have had a lot of representation out of North America and Europe historically. Now, I would say that locally, in Australia, like the top 10 super funds are very interested in investing in global funds, and they are looking to somewhat diversify their portfolio. And they've also built out kind of internal investment teams locally on the ground, which again is giving some momentum. So as an example, they like the global funds, but they're also very keen on region-specific funds, which we have not done yet. But there's been a lot of interest around, Brookfield launching an Asia Pacific region, an Asia Pacific real estate fund as an example. So I do think that there's a ton of interest there.
Yeah. What about on your side, Charlie?
Yeah, so what I would say is that the majority of our capital over time has come from the European market, the UK market, German market, but increasingly from Japan, Korea, Taiwan. Now, what I'd say about the Australian market is that, as Kira mentions, we have some very large super funds who are very active in infrastructure. During a long cycle of discussions with them, historically, I would say they've been underweight in this sector in terms of climate infrastructure. And that was partly because they were comparing renewables, for example, against conventional infrastructure, in a time when conventional infrastructure was delivering pretty high returns. I think COVID has changed that equation. And I think the move to net zero has changed that equation. So I hope to see and expect to see the Australian super funds move at significant scale into this sector through funds, but also directly in order to catch up with their peers in Europe and North Asia.
Yeah, and then you mentioned obviously the Koreans and the Japanese, and us, and you think of the scale of what you just described in their own backyard. I think you can see, for a lot of obvious reasons, why the local pension funds are going to be in that space. But what about Southeast Asia? I mean, there's also large pools of institutional capital sitting in those markets. How much appetite have you seen for those to be investing in their own, in the region, into the sorts of funds that you've got?
So, to be frank, I would say reasonably limited. You mentioned a good point at the start of this, which is there is a significant amount of capital available for investment in developed markets in well-developed projects. However, there is a significant need for capital in the developing economies, and that capital in many cases is not there. So we raised last year a fund called the Climate Finance Partnership, and that is designed only to invest in emerging markets. And it's that kind of fund, I'm afraid to say, is still required in order to get capital flowing into those markets. So I think as we think about evolutions of this sector, one is technology evolutions. We've talked about hydrogen, for example, but then it's also getting institutional investors comfortable about taking climate investment risk in emerging markets.
Yeah, and it's a really good point, because I think in your climate fund, I think there's some government, public sort of climate finance in there, to I guess help manage some of that risk. And so I think there's obviously a big role for that sort of blended finance model, I think, in some of those countries. But I guess coming back to those funds and others in their own backyard in Southeast Asia, it is interesting to me because, of course, there's lots of projects that happen. There's lots of infrastructure. There's stuff that's being done domestically. And if anyone has a best sense of the risk in those markets, it is the local investors, probably even less, more so than those coming from other markets. So, yeah, I think I would agree. I think it's there's a big opportunity and still a little way to go, I think, before we really unlock a lot of that institutional money sitting in Southeast Asia to deploy into those very key markets.
Agreed.
Kira, anything to add to that in terms of changing mix of your investors, or how you see that might change?
I probably don't have too much to add on that. No.
Okay, well, we might, Giles, I think we've got a bunch of other questions coming through there. I'm just conscious of the time as well. Do you want to jump to some of those questions?
Oh, I'd be delighted to, Paul. Thank you very much. Charlie, here's one for you. We've got a question about Southeast Asia, East Asia, Vietnam, Indonesia, Philippines. One person mentions, Vietnam's got 100 million population, 10% electricity demand growth rate per year, and a major manufacturing hub. Do these economies appear on your radar?
So they do for our Climate Finance Partnership Fund. So all of those markets are key target markets. Now, they are challenging markets. So Vietnam, as you mentioned, huge deployment of solar. However, a bit like in Australia, very significant grid risks, both in terms of connecting to the grid and then ongoing curtailment. And also the power purchase agreement that is in place in the Vietnamese market has challenges in relation to bankability. So I'd say that all of these markets increasingly appearing on our radar. Wasn't the case 3 years ago, is the case now. But we will be taking it step by step in those markets.
Okay. Kira, one for you. You mentioned factoring in green premium into investment returns, and the question is here: what are some of the levels of green premium or factors going into it where there is no express carbon price? Do you see green premium growing, or will people expect that over time green products should become price competitive? What are your views on that?
It's a good question. And I think there are probably many things to consider, I guess, in answering it. And I'm thinking about time frames, different asset classes. and the competitive dynamics at play. So I guess, yeah, I made the comment around green premium. I don't think there's any one answer to it. And I don't think it's going to be formulaic, at least when I think about our own investment thesis into assets. And I do hope that over time it becomes the norm, but I do think that that's possibly decades away. So I think there's still going to be leading businesses in the context of the transition. And I'm thinking even, this fund, so this decade, let's call it, who are achieving milestones much quicker. And I think I also am acutely focused on businesses or assets that could become obsolete if they do not transition. And so I think, yeah, it's maybe an unsatisfactory answer in terms of, I don't think that there is, a one answer to that question. But I do think some of those will be factored in terms of, some markets, yes, with a carbon price, you can quantify it in some ways at the moment, but that also might change, right? Like we've seen those markets change over the course of time.
I'm kind of fascinated with this green transition idea of sort of hopping into emitting assets and sort of trying to get change from within. And I know you can't talk about AGL, and there's no indication that Brookfield has any ongoing interest in there at all. So can we just sort of talk about it in sort of general terms? I mean, the idea of what seems to be a green investment fund and sort of hopping into like an emissions intensive business, you go, no, don't do that. You should be investing in wind and solar. So what's the thought processes going into sort of attacking the assets from within, almost?
So the business transformation theme, you mean, like in
Yes.
terms of, well, again, we saw that as being a pretty unique space because some people are pretty freaked out by touching. They can't touch carbon in the same way. So it kind of limits some of the opportunities. And so for us saying, well, A, that's where you can have the biggest impact, but B, it's a bit of a unique place to be. And, it does require some pretty heavy lifting, but I think that Brookfield's heritage as being a kind of asset manager, asset operator, and we go in with that mindset. So I think we're really excited, and to be honest, the investors and some of our largest investors are very, very excited as well. They're going to hold us accountable for the transition plans that we put in place, but we have quite a rigorous kind of reporting mechanism and analysis that we do going in to ensure again that those targets are reasonable and going to be achieved over the course of our hold. So I don't know. I mean, we could talk about, even just, coal to renewables. I mean, you're buying an asset where, to Charlie's point, access to the grid is a big barrier, right? And so you're almost buying a future green energy hub. You can replace thermal power with green power. And it's not as simple as unplug one and plug the other in, but that's maybe the simplest way to describe it. There's a lot more, technical capability that goes in behind that, but you can effectively do that as well. If you were to look at the grid and the issues we're having, part of that is going to slow the transition. So the quicker we can solve some of those problems, the better, but also the quicker we can just move out coal and put in green renewables in the same zone, like that's great.
That's really interesting. Charlie, here's one for you, maybe. Someone's asking about, do you sort of consider it to be your responsibility to deliver reliable power? I mean, I guess you've been talking about investing in some renewable technologies and wind and solar and stuff like that. I mean, obviously, firming capacity is going to be required because, we're just in the AEMO Integrated System Plan, the need for firming capacity, and we've heard it from the Energy Security Board as well. How do you think about it from an individual investor point of view, Charlie?
Sure. So what I would say is that going forward, I don't see there's a role anymore, particularly in a market like Australia, but in other markets as well, for standalone intermittent wind and solar. I think the battery storage is just going to play a huge role going forward. And often you need to look at projects through the lens of the battery first and renewables second. So I see there a real opportunity for standalone batteries. I see there's a real opportunity for batteries in households. I see there's a real opportunity for battery co-located with renewables. And that's going to form the bedrock for the energy transition moving forward. It's taken some time to come, but the cost of batteries have come down a long way. There's still question marks around that at the moment, with the overall theme of inflation particularly pervasive globally. But as scale develops in the industry through EVs, I'm very long battery storage and feel that as investors and platforms, we need to be delivering reliable power to the grid.
It's interesting you say that about the storage, because you mentioned before about some of you actually mentioned Australia as having problems with grid connections and things like that in the context of other countries. So to what extent do you need to see those sort of issues resolved, some of maybe the rules of the market being that much clearer? And I guess that sort of leads to a broader question about how Australia stands up as an investment destination compared to other countries.
So the answer to the first question is yes. And I think that Australia actually, although there is very large platforms out in the market, I think Australia has been through a period of investment freeze from some of the large investors in renewables and clean energy, following some of the MLF issues, grid curtailment, grid congestion, whole point issues that were in the market. Now, what I would say is that some of those issues are better understood now, and so capital is returning to the market. We, as you mentioned at the start, we have a new government that's supportive of the energy transition and net zero targets. So I actually see Australia coming back into view as a key destination for energy transition and net zero finance. And that's across a range of technologies. It's one of the key destinations for capital for hydrogen. And despite some slow progress, it's also a great place to invest in electric vehicle charging infrastructure.
Kieran, I just wonder if we can get your perspective on Australia as a destination, and if I can just throw in another one as well, because there's been a couple of questions about inflation and things like that, and how that might sort of change the sort of investment perspective. But do you, I mean, I think your particular portfolio is focused on Australia, but I mean, is it hard to get people, attract the funds that are interested in Australia, get the money so that you can then invest in Australia, or are you, to what extent do you compete? No?
Oh, not at all. No, I mean, from a fund perspective, you know, they really love Australia. And we have a lot of assets across our portfolio. So I mean, Brookfield is, you know, real estate, infrastructure, private equity, and renewables. And so, you know, in terms of as a destination point, it's high up on the radar. And I think APAC more generally, which I think Charlie gave some really good statistics in terms of growth. I think the view is that there's tremendous growth, whether it's Australia or, you know, the rest of APAC, when you look at the propensity or the amount of capital by fund, because we don't have any specific mandates in terms of allocation. You don't have to spend X amount in APAC, but I would say there's a lot of focus and excitement around it. And then in terms of the inflationary environment, I mean, you know, different assets, you know, may face different challenges, but I don't think from a renewables perspective, we're too worried. I mean, some of the supply chain issues in the context of solar, I think are going to be short-lived. I don't think they're going to be, you know, again, if you're taking a 10 to 12 year perspective, you know, you'll just have to manage it accordingly today. But we normally do take that longer term view rather than kind of short term.
Cool. Paul?
Yeah, well, we're almost on the hour. I just wanted to touch on debt markets, because I feel like we've obviously really focused on all that institutional equity, and indeed I think we see a lot of your funds being able to play in the debt markets and being, you know, able to lend into these projects, I guess. And we've had obviously a very low interest rate environment. So maybe just two questions to each of you. How do you use or see debt playing a role in your funds and the deployment of that into projects? And then secondly, you know, with rates now going up, how do you see that's going to impact that role? Maybe Charlie, do you want to kick off?
Sure. So I would say that debt has certainly got more expensive in the past few months. That isn't restricting the supply of debts. We've just recently closed a refinancing of our portfolio in Taiwan, and that was 70% oversubscribed. So for operating green assets, the market is awash with debt that remains cheap compared to historical standards. Now, the approach that we tend to take is that we don't like debt to hold us up when we're looking to build assets out. And so we tend to build assets out on an all equity basis and then look to refinance and get the best possible terms. So I think we'll continue that approach, and I would say that the rising rate environment makes that approach even more sensible, given that there's a compression between the cost of debt and the cost of equity.
Kira, how have you mobilized debt in the context of your funds?
Yeah. Maybe I'll just add on to Charlie's responses in terms of, in the context of the transition fund, I think one thing that's been kind of exciting to see is that globally, banks' objectives are very, very aligned with the mandate of the fund and decarbonization. So I think, there's a lot of motivation for them to kind of own the emissions of companies and projects that they either own today or look to invest in, again, assets that are either avoiding or ensuring avoidance of, in emissions intensive assets in the future. So I think, from that perspective, there's a clear alignment of the objectives. And then, in terms of strategy, I agree with Charlie. I mean, early on in the development of these assets, we absolutely can go with equity and then get project finance or refinance at a point in time when there's a lot more certainty around the cash flows, aka the PPA is all signed up, and that's kind of the opportune time to get them on board.
Yeah, and I think that's a really key point, because it reflects, I think, my observation at the beginning, which is that, we've seen investors like yourselves move upstream to take, years ago it was, first of all, take a bit of construction risk, and then it was development risk. And I think that's a big change in the market, that you've got, large, investors with large balance sheets able to do and build projects out on balance sheet, and then the role of debt sort of in refinancing that. I mean, it's been certainly a huge change in the Australian market, and I think that's probably here to stay.
Yeah.
We're just on the hour. I think maybe, Giles, we've got time for one more question, then I think we will have to wrap it up.
Let's make it a short one. Did you want to ask about Ukraine, Paul? I'm not too sure we've got any other questions.
Yeah, well, I guess I guess the question there really is, do you see that in and of itself really accelerating what you're already doing, or do you think it's going to present you with some more challenges to deploy capital the way that you've been trying to do? I mean, we've obviously seen some short-term effects around the impact of that, old coal-fired generators being fired up in Europe, impacts on supply chains and all of that. But yeah, maybe just your thoughts on what that means in terms of what your funds are aiming to do. Maybe Kira, do you want to go first?
Yeah, sure. I mean, from a European perspective, I think obviously the war demonstrates the reliance on Russian energy, and that it could be, fairly problematic. But I think we've been here before, on numerous occasions where Russia has withheld gas from Ukrainian pipelines, for example, and rewiring and replumbing the continent's energy markets will take time. And we clearly need to take advantage of all options that are, available. But I think the good news is that, as a economy, whether, I'm kind of talking about Europe, but even, Australia, we're definitely all seeking more energy security and stability. And we're much further along in the energy transition than we were a while back. So I see it probably providing, positive momentum to that. Like, I don't think it's going to stall it. I think it's kind of pushing countries to ensure, independent, stable supply and energy security, and effectively diversify away from Russia.
Yeah. Charlie?
Yeah, so I would say that COVID, from my perspective, accelerated the energy transition and net zero transition by 3 to 5 years. I think we'll also look back and say that the war in Ukraine has done the same, particularly looking at activity in clean energy investment in Europe. We're seeing a very considerable spike as people are looking to roll out renewables as quickly as they can, owing to security of supply concerns. So I think we've had two pivotal moments in a very short space of time, and it all points to the road to net zero.
Yeah, no, I think that's a really good observation. So look, we'll finish it there on pretty much on the hour. So thank you both, Charlie and Kira, for joining us and sharing all of that great insight and discussion. That was really interesting. Appreciate your time. And thanks, Giles, for co-hosting once again. Thanks to Renew Economy for partnering with us on this webinar. There is a recording that will be available through the Renew Economy website, so feel free to share that. And maybe, Giles, I'll hand back to you for any final comments.
Well, thank you, Paul, and thank you, Kira, and thank you, Charles, for joining us today. Thank you to everyone out there who who's signed in and listened, and to this webinar, and also the other 3 webinars that we've held in this series. So once again, thank you all very much. The recording will be there. You'll be able to find the other webinars, and also part of the podcast series that we've also been done with Ashurst as part of the Energy Transformed. Go well, everyone, and thank you very much for joining.